So let's get started. Why construction accounting drives your rates? Well, the fundamental truth is you as a co-op or utility, you have to recover 100% of your costs in order to provide reliable service to your customers. And that includes your ratepayers paying 100% of the construction costs. So every dollar you spend on construction eventually flows into your rates. And that's why accounting for construction really matters, because if you have inadequate rate recovery, when it comes time to replace these assets, you will not have the funds available to do so. So let's look at an example. So here we have a project. We build a new three-phase distribution line for $500,000. We capitalize the project, and so the $500,000 moves from construction work in progress to plant and service. Then we depreciate this asset over, say, 40 years or so. That equals $12,500 a year in depreciation expense. And this flows into your rates so that when it comes time to rebuild this three-phase distribution line after 40 years, you have this historical cost of $500,000 set aside, which is $12,500 times 40 years. But there's more to it than that. 40 years from now, it's not going to cost you $500,000 to replace that three-phase distribution line. It may cost you quite a bit more, probably double, triple perhaps. Where do you get the money for that? Well, you also have a return on investment. So we take that $500,000 and we apply a return on rate base, which is the cost of the project times that return on rate base, which is based on your cost of capital, which we'll show you later how to figure out. But for example, here it's 7%. So that equals $35,000 per year. We add that to the annual depreciation expense, and so the annual cost to your ratepayers is really $47,500. So that's every year for 40 years. So if you get this initial capitalization wrong, it'll be wrong for 40 years. You have like a one-shot time that you can capitalize this project and make sure it's fully costed with what we call the hidden cost multiplier, or overheads. So overheads can add 60 to 200% to every project. So we take these direct costs of materials and labor. We have our labor overheads, say there's 75%. Perhaps we tack on 15% for materials overhead. We have equipment overhead. We have allowance for funds used during construction. And say our direct costs of $100,000 on this particular project, really, after adding overheads, are $150,000. So you can see we could be off by a factor of 1 and not recover those costs. And when it comes time to rebuild those assets, we will be short on funds and have to make it up in rates at that time, which runs counter to the theory of that current ratepayers need to pay for their current costs of providing service. And that includes replacing the assets that you have in service to serve them. And you'll see how this plays out as we go through each module. So accuracy matters for rate fairness. You don't want to undercharge overheads. You don't want to overcharge them either, but there are ways to calculate them that are fair and obvious to your ratepayers. Also, regulatory compliance. If you follow strictly FERC and RUS standards, those require proper overhead allocations. And then financial accuracy. If you don't include overheads, your balance sheet will be understated, your income statement will be overstated, and that mismatch doesn't really reflect the reality of how you provide service. And then there's cost control. If you don't measure it correctly, you can't really manage a project without the proper cost of overheads and the direct labor and materials. So what happens is, on the accounting side, when it comes to classifying these projects, putting them in the right slot, the right general ledger account, we use what are called standard units. So instead of calculating overheads for every single project, we use standards that we apply to every project, and then we build these standard units, which we'll show you how to do as well, that we compare then to the actual cost, and then those costs are reflective in the general ledger. Standard units are also handy too if you do outsource work, if you're building subdivisions, things like that. You have developers coming in, you'll know a good estimate of what it should cost you to build those assets and what to capitalize, and then what also to charge these developers up front to reimburse the utility or co-op for this work. So as a person responsible for construction accounting, really it would be your job to calculate these overheads, build the standard units, ensure the costs are classified correctly, and then close the projects correctly, what we call the unitization. We'll show you how to do that as well. And then all of this together provides that foundation for fair and accurate rates. So what we'll provide you with as the class goes ahead, we'll give you the tools to do this work and not second guess yourself. We'll show you how to identify and track the 4 cost types, calculate those overheads, build the standard units, and apply those overheads correctly no matter the type of system that you use, and then get them in the right slot. So the key takeaways from this module are this. Your ratepayers should pay 100% of construction costs through depreciation expense and the return on investment. If they don't, you will not have the funds available to replace these assets when they need to be replaced 30 to 40 years from now. This includes the overheads that can double or more than double the cost of a project. And then using standard units makes this process a lot easier than it sounds. So as we go ahead here, we'll see how it all fits together. By the time we get done with Module 10, you will be a construction accounting expert for FERC and RUS. So let's move on to the next module.